Inside the Investor's Brain book is a deep dive into the psychology of financial decision-making. This book bridges the gap between neuroscience, psychology, and investing, revealing how emotional and cognitive biases influence market behavior. Unlike traditional financial theories that assume investors are rational, Peterson provides scientific evidence from behavioral finance and neuroeconomics to explain why traders often make irrational choices. The book is structured into multiple sections that cover topics such as how emotions affect financial decisions, the neuroscience behind risk and reward, common psychological biases, market behavior, and strategies for improving decision-making. The core message is clear: success in investing requires mastering one's own mind as much as understanding the markets. Part 1: The Emotional Investor, Understanding How Feelings Drive Decisions. Chapter 1: The Illusion of Rationality. The book starts by challenging the traditional economic assumption that investors always act rationally. Peterson argues that most financial decisions are emotionally driven rather than based on logic. He introduces behavioral finance as a field that studies how emotions, biases, and heuristics, mental shortcuts, influence investment behavior. Why this matters: traditional financial models fail to account for the emotional impulses behind market movements. This chapter sets the foundation for understanding how fear, greed, and overconfidence drive the stock market. Chapter 2: The Role of Emotions in Financial Decision-Making. Peterson explains how different emotions trigger specific financial behaviors. Using neuroscience, he shows how the brain's limbic system, responsible for emotions, often conflicts with the prefrontal cortex, responsible for rational thinking. For example, greed activates the dopamine reward system, leading to excessive risk-taking. Fear triggers the amygdala, causing panic selling and risk aversion. Why this matters: traders who recognize their emotional triggers can make more rational, well-balanced decisions. Part 2: The Brain and Investment Decisions, The Science Behind Risk and Reward. Chapter 3: The Neuropsychology of Financial Markets. This chapter explores how the brain processes uncertainty and probability, showing that humans are naturally bad at estimating risks. Peterson explains concepts like loss aversion, where losses feel twice as painful as equivalent gains feel rewarding, and the fight-or-flight response that leads to impulsive trading decisions. Why this matters: understanding how the brain reacts to risk helps investors avoid making fear-based decisions. Chapter 4: Dopamine and the High of Winning. Winning trades trigger dopamine release, creating a sense of euphoria and confidence. However, this can lead to reckless behavior, as traders start believing they have a special edge and take excessive risks. Peterson draws parallels between gambling addiction and speculative trading, warning about the dangers of overconfidence and excessive leverage. Why this matters: professional traders learn to detach from emotions and develop discipline, preventing dopamine-fueled overtrading. Chapter 5: The Fear of Losing, Why Investors Hate Losses. Peterson discusses how the brain reacts more strongly to losses than to gains. He introduces the concept of prospect theory, which explains why investors hold on to losing stocks too long while selling winners too early. Why this matters: learning to accept small losses as part of the game is key to long-term success. Part 3: Cognitive Biases and Their Impact on Investment Behavior. Chapter 6: Risk, Reward, and the Emotional Brain. This chapter focuses on the battle between emotional impulses and rational decision-making. It explains how traders can train their brains to handle financial stress, avoid panic decisions, and develop a disciplined trading mindset. Why this matters: successful investors build mental resilience and develop strategies to manage emotional triggers. Chapter 7: Cognitive Biases and Market Behavior. Peterson breaks down the most common psychological biases affecting traders, including overconfidence bias: traders often think they are better than they actually are. Confirmation bias: seeking out information that supports existing beliefs while ignoring contradictory data. Herd mentality: following the crowd leads to market bubbles and crashes. The sunk cost fallacy: holding on to bad investments just because money has already been lost. Why this matters: identifying and eliminating these biases improves long-term profitability. Part 4, The Market as a Reflection of Collective Psychology. Chapter 8, Herd Behavior and Market Bubbles. This chapter explores why financial markets are driven by collective emotions rather than rational analysis. Peterson provides historical examples of speculative bubbles, such as the dot-com crash and the 2008 financial crisis, explaining how investors ignore warning signs in euphoric markets. Why this matters: recognizing signs of market euphoria helps investors avoid catastrophic losses. Chapter 9, The Role of Media and Noise in Trading. Financial media plays a major role in shaping market sentiment. Peterson discusses how news, rumors, and expert opinions can create irrational price movements, leading traders to make poor decisions based on hype. Why this matters: filtering out noise and focusing on data-driven decisions helps traders stay ahead. Part 5, Training the Mind for Investment Success. Chapter 10, Mindfulness and Trading Discipline. Peterson introduces mindfulness techniques to help traders stay calm under pressure. He argues that meditation, deep breathing, and emotional awareness can significantly improve decision-making. Many top hedge fund managers practice meditation to control emotions. Why this matters: developing emotional resilience is a key trait of successful traders. Chapter 11, Creating a Personalized Trading Strategy. This chapter focuses on the importance of self-awareness in building an investment strategy. Peterson suggests that traders should identify their emotional triggers, develop clear entry and exit rules, use risk management techniques like stop-loss orders and position sizing. Why this matters: a structured approach reduces impulsive trading and increases consistency. Chapter 12, Long-Term Thinking and Patience. The final chapter emphasizes the importance of patience and a long-term mindset. Peterson contrasts the behavior of short-term traders, who are often driven by emotions, with long-term investors, who rely on disciplined strategies. He discusses Warren Buffett's approach and why focusing on fundamentals rather than daily market fluctuations leads to superior results. Why this matters: patience and discipline separate successful investors from those who constantly chase quick profits. Final thoughts on Inside the Investor's Brain. Peterson's book is an essential read for any trader or investor who wants to improve their financial decision-making by understanding the psychological forces that drive markets. It offers scientific explanations for why investors make mistakes and provides practical strategies to overcome emotional biases. Who should read this book? Day traders, swing traders, and long-term investors who want to develop a rational, disciplined mindset. Anyone interested in behavioral finance and neuroeconomics. Traders struggling with emotional decision-making and want to improve their mental resilience. Key takeaways: mastering emotions is just as important as technical analysis. Understanding biases helps investors avoid costly mistakes. Mental training and mindfulness improve long-term success. By applying the lessons in Inside the Investor's Brain, traders can develop a psychological edge, allowing them to navigate market uncertainty with confidence and discipline.